Get right to the floor show and B. Riley Wealth Management Chief Market Strategist Art Hogan. Art, you still got about 57 minutes before we can put the pencils down, as you like to say. The problem that triggered the sell-off midweek was that this 30-year bond yield hit a 19-year high of 5.3% amid inflation concerns flaring up, along with the fact that the national debt topped $40 trillion for the first time. Will those two things be next week's problems as well, or pushed aside once the closing bell rings in now about 56 minutes?
Yeah, Liz, any given day this month, and this month is a tough one for markets because volumes are very low and the trading is very skinny. We're trading about 30% of our usual average daily volumes. But that said, any given day you wake up, the first thing you look at on your screen, I know you probably do the same thing, Liz, is where's the yield on a 10-year and what's the price per barrel of oil? And that seems to be usurping just about everything else, especially in a catalyst-light week like we've had this week. I think either one of those calming down a bit, and they're very related and correlated to each other, and I think we can get some relief. Part of that relief may come at the end of next week. We've got Jackson Hole. We may learn more about the path of monetary policy and what some of the inflation reaction functions may be. So that would certainly help, because I think part of the concern at the long end of the Treasury curve is just where do we stand on monetary policy and what would it take for the Fed to either hike or stay where they are. They're likely not going to hike at the September meeting, but I certainly think more information about how they're going to be operating with a new chairman would certainly be helpful. And anything that pulls energy prices down is certainly going to be helpful to pull Treasury yields down as well.
Well, look, the 30-year Treasury yield, if you round it up, it's back at 5.3% here, Art. So, there was this moment where Treasury Secretary Scott Bessent, we woke up on Wednesday and he had basically intervened in the markets and in essence said we're going to double the amount of bond purchases that we make between September 9th and November 9th. That to me looks like an intervention, not a bailout, that's a little bit too strong, but something about that has concerned him. He would deny it. He said, no, it's not that. But why make that move? Why start buying that many more bonds to bring the price up and then bring the yield back down? And it's kind of not working here.
Yeah, it's not working. It's, this operation is kind of an operation twist, because what you're basically doing is taking some off the run 10-year and 30 years out of the marketplace, but then you're issuing more on the front end. So on the shorter end of the curve, you have to increase your issuance by what you're taking out of the back end. So the net Treasury market is still exactly the same. It's just yield curve control, right. And that piece of it typically is much more of a job boning. And he certainly come out and said post this that it could be more than the initial amount that they doubled it to. I think it's much more of a function of the frustration with how quickly yields have moved up, which I think is more a signal coming from the Federal Reserve than it is from the Treasury, because we just don't know what it's going to take for the Fed to take action. We've got a new chairman who's been very circumspect about what it is that the Fed's going to be doing now that there's a new regime in town.
Let's simplify this. Higher bond yields mean higher borrowing prices. So you're looking at a lot of borrowing going on, specifically in tech. But let's stretch it out to year to date and the sectors that have done well and the ones that have not done well in the S&P 500. I mean, the worst performers year to date would be consumer discretionary, communication services, followed by utilities, which has had kind of a measly 2% gain year to date compared to energy, up 42%, or, info technology, which of course is the AI trade, up 20%. What do you like here? If you were to pick out some names from all of these sectors, what catches your eye?
Yeah, the interesting part is when you look at this, energy is a pretty obvious equation, right? We've got higher energy prices, so that sector's done very well. And clearly the industrials, which have done very well, is very artificial intelligence adjacent, right, with all the data center build out. To me, I think the two sectors that likely have the best ability to move forward over the course of the balance of this year are going to be the financials, which have had a rough week, but a good start to the year and a good start to the second half. And I think the three things that they have going for them is in this lighter regulatory touch environment we're in, there's going to be a whole lot more M&A activity. There's certainly a lot of capital markets activity. I think that the yield curve is working in the right direction for them, and I certainly think that the valuation for the financials is still very reasonable. Another sector to look at is healthcare. Now, it's no surprise that it was the best performing sector this week. Moderna and Merck coming out with a new potential for vaccine for cancer is just the tip of the iceberg. One of our favorite names there would be Eli Lilly. They're clearly the GLP-1 winner and continue to have things in the clinic that make them them even further their lead in the GLP-1 race, but they've also made 5 acquisitions this year. Away from that, if you like technology, the cheapest play in technology of the Mag 7, which have really done nothing this year, is Apple. They didn't spend tens of billions of dollars developing a large language model, but they're going to be how we consume artificial intelligence on the 2.5 billion devices they have out there. So I think that's important to keep an eye on. Very reasonable valuation for Apple and a very shareholder-friendly management. So with the new rollout of their phone coming in just about a month, I think we're going to see Apple continue to move forward.
Let me just jump in there for 1 second, because there is a headline hitting the tape, a Bloomberg report that Apple is announcing about 200 job cuts. Most of them are coming from, say, for example, the Siri division, not to mention the Vision Pro immersive video and gaming teams. That's just something I wanted to get out there for our investor audience. The stock is down about 1% at the moment. And then a quick line on NVIDIA, because it's widely held. A lot of our viewers own it. You like it?
Yeah, it trades at 20 times next 12 months. That number is going to go down next week when they report earnings. Now, they may never be able to say anything good enough to continue to get, because everybody already owns it. But when you're trading at 20 times, you've got gross margins that are north of 75%. You've got net margins north of 65%. You're growing both your earnings and your revenues north of 100% this particular quarter. I just think it's the cheapest of the semiconductor and memory plays right now. We'll learn more about that on the 27th when they report.
Yep, we sure will. And we will have the CEO, Jensen Huang, the day after they report. So great to see you, Art. Pencils down soon. You've got just about 51 minutes left to trade. Thanks so much.
Thank you so much.